Hello everyone, welcome. In today's video, we're going to talk about range and why is it important to understand range as a smart money concept trader. So, let's get started. So range is a sideway correction or consolidation. You can easily spot it when price action moving sideway. Okay, so range is, what it sounds like here. It is when price moving in a sideway direction. It didn't really go up or going down. When you see price moving to the right side and it just didn't really making big move for you to trade, that is a range. Okay, you can also spot it by drawing a small box over that price action, and you see that it stay between that box, right? So that is a range. Range can be found on all time frame, so it doesn't matter if you're using a 4-hour time frame, 1-hour time frame, 15-minute. Range can be found on all of those time frame, but my favorite one I really like using, two, it actually 15-minute and 1-hour time frame. Those are the two of my favorite time frame that I use all the time to find range for my setup or my trade. Okay, we don't trade the initial move from that range. We wait for price to come back and retest that zone again or that range again. Okay, so we don't really trade that initial move to the upside or to the downside. We wait for it to come back to that range that is created earlier, and then wait for that, way to trade that move to the upside or to the downside. The reason we wait for it to, come back to that zone and not really trading the initial move is that when price created this range, it has liquidity above it, right? Or below it. And that time, we don't really know where price wanted to go. So we cannot really just jump into the trade. We don't even know where it wanted to go, right? So we wait for it to move, either to the upside or to the downside, and then we be able to figure out where price really wanted to go. In this case right here, right? The range created demand. Price breaking that range to the upside, and then now we know where is the direction. And then we wait for price to come back to that range and continue to the upside. Okay, and the same thing with the range created supply. After we have that range and price break out of that range and come back to that range right here, this is where we're looking for that trade to the downside. Not a guaranteed trade. What does it mean? It means that when you see that price break out of this range right here, when it come back, it's not always an entry or a trade, right? We do not trade it right away. We're waiting for more confirmation, of course. But that is where we're looking, that's the area that we're looking for the trade to the downside. Okay, we need more confirmation, not just price come back to it and trade it right away. We're waiting for more confirmation, but that is the area we're looking for that trade to happen, right? We want to see price rapidly moving away from the range. We don't want a slow or corrective price action. Okay, so here is a little demonstration here. So you see that range is created, but the way that price moving away or break out of that range, it's not rapidly moving away like this one right here. You see, it's moving away in a very slow or corrective price action. And the reason we don't like to see this or we don't want to trade this is that when price correctively moving like this, break out of that range, what does it do is it created liquidity below this low. So when it's starting to do this, it created liquidity. What is price going to do? It wanted to come down and take out those liquidity, right? You see, when price break out in a corrective way like this, what does most of the time? It's starting to, again, building liquidity below this low, right? Sometimes you can see that price going above this range, some of the traders starting to jump in earlier. So when they try to jump in earlier, they're starting to use stop loss, right? And where are they going to put their stop loss? They either put it right here, or right here. And that's when price wanted to come back and take out those liquidity, right? The same thing with this one right here. We don't want to see price correctively moving away from that range. We want to see it moving rapidly, right, away from the range, because the same thing, it's starting to build liquidity above this high, and that is not good because price going to come back and take out those liquidity, right? So that is range, and that's how it works. So let's go to another part here, type of range. So there are two type of ranges that I wanted to show you here. So this is the first one. The first one is the range that is created by two candle. When it comes to range and type of it, it has a couple, but this is the two that I use the most and I see play out a lot. It's the range that created by two candle. What does this mean? It's mean that this whole range right here, right? So by the way, the range that is most of the time that I like to use is between 4 to 8 candle. I don't want to use when it's so many candle, like 20, 30 candle. That is kind of like really messy, and I don't really like that. So my favorite range is when it created by between 4 and 8 candle. Those are really really effective range. So in this example here, you see that this whole range is covered by this two candle, right? It covered by this two candle right here. And the reason you want to use both of it and not just one is that for example, you use this one right here, right? And price can come back and not really, it didn't really go to that range, right? It just come to right here, which is touched this candle, and it's starting to reverse. And that could happen, right? So that is the reason why you want to use both of the candle. When it comes to range, it has a lot of flexibility, but you have to understand, in this type of condition, do should you use one or two candle? And in this particular example, two candle is the best option because it cover the whole range, right? So you want to use two candle, not just one candle, okay? In this case, and the same thing with this one right here. Two candle cover the whole things. We want to use that two candle before that move, breakout, right? Come back and continue to the upside, okay? And another type of range that I see a lot of that move that I like to use a lot is the range that is covered by this one candle right here. And the reason why we want to use this is that you can see that there's multiple candle, but this one candle, it's covered the whole things, right? It covered the whole range. It covered this candle and also this candle right here as well. And that is why we want to use it, because if you use, let's say, this candle again, price could just come back around this area and it starts to reverse, and you could miss the trade because you're using the wrong candle, right? So these are the two type of the range. Again, back to this one here, the same thing. Big candle, cover the whole things, cover the whole range. You want to use that one, not other candle, because if you use the other one, you kind of cut out like this. It cut out the candle, cut out the range. Like this, it cut out the range. It's not really precise when it comes to, right, the range that you use. So yes, this is it for today's video. It's just to show you what is a range and why is it important to choose the correct type of range to use in your trade. So I'm going to see you in the next video. We have a lot of video coming up, so subscribe, and I'll see you in the next one. Peace.